Wintrust Business Lunch now with Phillip Shaw, the senior advisor at the Goldstone Financial Group. Do you know which day the markets are going to be up and which day the markets are going to be down, Phillip?
You know, John, if I knew that ahead of time, I'd be a wealthy man, right?
I knew you were going to say that, but I
don't think anybody does.
But I mean, sometimes it's down 400 or up 500, and you think, well, we should have seen that coming, but you wake up and you don't know, do you?
No, I mean, you know, if you look at your timeline, right? How confident am I 5 years out? I'm pretty confident the market will be higher. 3 years, it's a toss-up. Is the market going to be up, down, or sideways in the morning? That is always a good question. Like, I don't think anybody can predict world events, and, you know, there's always going to be something new coming our way.
But in my little world view, it would seem to be like the things that would move the market would be large enough macro events that people who follow these things would anticipate them. And yet, I appreciate your candor on this, but it's really hard to know the vagaries of what's going to move the market.
Well, I think coming up here, what the market's anticipating is Fed movement. What is unemployment going to look like? You know, over the longer term, you know, even shorter longer term, right? We have questions around how profitable will artificial intelligence be? You know, is that going to end up being a bubble, or is that going to end up being a really profitable sector of the economy?
Is that a terrifying question, by the way? I mean, if AI and NVIDIA aren't for real, then we're screwed, right?
Well, I wouldn't say that, but it's, you know, the concern I've always had coming into this has been looking back at like the internet boom and bust of the late 90s into 2000 is we're seeing a really similar trend right now. And that doesn't mean that it's going to break down the same way that the internet bubble did in 2000, 2001.
Yeah.
But it has that risk. We're investing an absolute, you know, colossal amount of money into data centers, chips, and technology. And if we don't have the revenue on the backside, we'll see the market react to that pretty quick.
Well, that's my point. It feels a little like this now, even though it seems like this can't miss. And the internet's for real. We just didn't know what the hell to do with it, I think, when we had pets.com. But I'm hopeful that all of this money that is being poured into artificial intelligence apps will generate sufficient revenue for these companies to stay viable, and that all of the companies that are using them will be able to justify the expense. I mean, that's the calculation, right?
That is the calculation, and I'm going to forget who published it, which university, but there was a study a couple of weeks ago, 95% of AI-related projects being undertaken were not profitable at this point. And they don't need to be profitable yet. You know, companies are okay to lose money for a time while they develop these programs, while they develop, you know, the business model around it, but they can't lose money forever. So that's where we got to pay attention to it and say, is this, you know, to your point, is this for real? Or similar to the internet, is this for real in the long term and maybe a little bit overhyped today?
Well, I think we can live with that. Phillip Shaw is a senior advisor at the Goldstone Financial Group. Which of the reports this week are you focused on?
So this week, I'm taking a look at the jobs data around all this, but, you know, they're always going to have revisions. My concern is more is the Federal Reserve going to start reducing interest rates in, you know, a couple of weeks' time here? I think what we'll see in the jobs reports this week is a continued slowing of the job market. You know, we've already had the JOLTS number come out showing a cooling labor market. I think we'll start seeing a little bit higher unemployment come through, you know, as early as tomorrow's report. And really what I think that'll end up meaning is that the Federal Reserve will start reducing interest rates. And that's really where our head's at and what we're paying attention to right now.
Talk about a JOLTS report. If they don't lower interest rates, I wonder what we will say about the economy, what the president will do, and what the markets will do if we don't get a quarter point in September.
Yeah, I think it's going to just put a lot more pressure on, you know, Chair Powell to reduce rates if we don't see it in September. You know, coming out of Jackson Hole, we've gotten an indication from him that he's going to start reducing rates, or at least that it's a concern. And as the president continues to stack more people on the Federal Reserve Board that are looking for cuts, we may see more pressure and might see that start to happen.
Yeah. The president will always find a way. This one will, won't he? If he can't get the head of an agency to do what he wants, he'll fill the governors or the board members to pressure or eventually get what he wants. What do you make of Donald Trump's influence on the Fed chair and also the governors?
Well, there's always been a certain amount of influence. I think Trump has been more vocal and more apparent about what he wants to have happen. That said, they're still independent, whether or not they're a conservative or liberal leaning member of the board. They are independent. They don't have any actual, obligation to do what the president tells them to do. So, him continuing to appoint people is just trying to get people like-minded on the board. Doesn't necessarily mean they'll do what he says all the time.
Well, they only have one thing to do. I mean, basically, we consume them as rates up or rates down. I suppose if you appointed a conservative judge, you can't exactly know the myriad of cases that judge would see, how they would rule. But one would expect if he had enough members of the Fed to reflect his financial view, his worldview, that he would get the sort of direction that he wants, right?
At least in the short term, they're going to push for a lowering of interest rates here. But over the longer term, they're going to have economic factors that they care about, and they may not be in line with what the president thinks.
Yeah,
maybe. I think everybody's on board today that we need rates lower.
Yeah,
whether that's true 2 years out is a different question.
Is there a part of the market that you like right now? Most of the guests that are coming on here are telling us it's pretty expensive. Where would you spend money right now in equities?
Well, part of the issue is in a bull market, everything feels expensive, but they generally continue to trend higher.
Yeah.
This is not the first time we've seen that. I'm not expecting any kind of, really strong end of year rally. And I do actually think we have a couple of risk factors. You're talking about Trump's influence a couple of minutes ago. I do think one of the risks we have is if the Trump tariff policy is reversed, which we've seen another court ruling stating that a lot of those were not legal. What is that going to do to a lot of these trade deals, a lot of the capital investment into the country that's been promised? But what is that going to do to all of these international relations that we've renegotiated? We've convinced them to invest in our economy. We've done all these tariffs. If that gets unwound, what does that actually do to the market? It's probably not good.
That's interesting because I hadn't thought about that. I'm aware of the ruling that you're talking about, and then there's the question of will the administration abide by it or will the Supreme Court overturn that ruling? But if in fact that sticks and these tariffs seem to be extra presidential, he does not have the right or power to do that, and we conform to that, you think that would be bad for our economy? I remember when we had Liberation Day, the market tanked. You actually think that if we said, in fact, we can't do what the president is doing, that will harm the markets?
Well, Liberation Day, we kind of brought out the big stick and we started to leverage tariffs on trade negotiations with really all of our major trading partners. And we've come to deals with most of them, with the EU, with Japan, right across the board. We started to have these broad-ranging deals. If it turns out that we were never able to use that big stick in the first place, are our trading partners going to abide by those? Or are they going to start unwinding these deals we just made?
Yeah.
What kind of other issues are we going to run into if it turns out that, the threat was never real? Because we never really imposed tariffs on most of those countries. We deferred, we delayed, and then we came to a deal and a negotiation.
Okay, just a couple of minutes left. We're talking to Phillip Shaw. He is a senior advisor at Goldstone Financial. Bob Freilich was on with us earlier this week, and he thinks the Dow's going to hit 50,000. He knows he's an outlier and an optimist, but he thinks we'll be there by the end of the year. What's your reaction to that, Phillip?
I agree with him. I think he's being optimistic of that. The expectation, call it 3 years into a bull market, is single-digit returns across the board. We're at about 10% on the S&P, or about 7% on the Dow. I'd be surprised if we had another 10% rally between now and the end of the year.
I'd be happy if we just stayed even, to be honest with you.
I'd be happy to be right where we are. I think the only way you see that kind of rally is if we have concurrent rate cuts and larger than we think. If it turns out that Powell comes out in September and says, here's a 50 basis point rate cut, and we're going to do another one in October, then we'll probably see that before the end of the year. I just don't think it's going to happen.
What are you telling your clients when you visit with them these days?
So we're always sticking to the long-term planning. So, if it's short-term money, it's generally not allocated into the stock market, and it's a long-term strategy, right? We're executing on financial planning and making sure we're investing the right way for the long term. What I'm telling folks is, short-term, we might see some more volatility, especially around what's going to happen with the Fed, what's going to happen with the tariffs. If you look 3 to 5 years out, we probably won't be as worried about tariffs at that point. Even if these are rescinded, even if we have to pay back $100 billion of tariff revenue and all these other, knock-on effects of potentially scaling back the tariffs, even if that happens 5 years out, we won't be focused on it anymore.
Yeah.
Right. Odds are the market will be higher and we'll have something else we're worried about.
Well, hooray for that. But we would have some certainty is the point. Eventually, this is going to be worked out. And I had not thought about the idea that we would claw back the tariffs that the courts might say were illegally got. Is that a possibility?
Oh, that is a certain possibility. And it's around $100 billion that we may be, forced to pay back if that happens. My concern is that if that happens, we use tariffs as leverage in a lot of ways. So are these companies that are investing, hundreds of billions of dollars, think, Apple, think that the chip suppliers, are they going to continue to do that without that leverage in place? Are we going to have the same trade deals if that goes away?
Right.
That's the bigger concern.
Phillip Shaw, Senior Advisor, Goldstone Financial Group, goldstonefinancialgroup.com. Really interesting, Phillip. Thanks for your help today.